Joining us now, Roger Altman is founder and senior chairman of Evercore. Welcome back. We're here on Friday for a different reason. That was a great segment. But
thank you for having me.
Yeah, you're welcome. And we always, you're founder of Evercore. You know about money as well as a lot of things about your own personal experiences. Why is the stock market shrugging off so many what would be perceived as headwinds, or really? I mean, more than just headwinds, with $106 oil and rates backing up, and no idea how this ends in Iran at this point.
Well, I think the big question of the moment, including reflecting events over the last 2 or 3 days, is whether we're now at a tipping point in terms of the oil market, and whether we're about to see over the next, say, 2 weeks, really substantially higher oil prices. Why would that happen? Because 12 to 14 million barrels a day have been taken out of the oil market against the average daily global consumption of about 102 million barrels.
Okay.
And that effect has been cushioned, and I think Dan Yergin might have referred to this, by high inventories. A lot of tankers at sea that were full, strategic petroleum reserves which have been released, and high China inventories. All those now have been drawn down a lot and are about to really lose their cushioning effect on the market. So the oil experts I talk to tell me that pretty soon we're going to see the spread between the price that people actually pay for physical crude when they actually want it to be delivered to them, and the paper price on our screens is about to widen, and then the paper price will go up a lot. And the underlying question is, can markets remain stable in the face of that? I would be skeptical of that, but I can't be sure. You're right that the underlying momentum of the markets, which I think is driven by corporate profits and a strong U.S. economy, is powerful. I mean, we have a huge boom in business fixed investment going on. It's centered in AI, but it's not limited to AI. It's a lot of manufacturing investment, a lot of machine learning, robotics-related investment. We have a resilient consumer, the wealth effect of the stock market on consumer spending, clean balance sheets, the fiscal impact of the one big beautiful bill, and we have a high rate of new business formation because technology is lowering the barriers to entry to starting businesses. So the conditions of the markets and the economy before we may see these higher oil prices really very good. So are we at a tipping point? A lot of oil experts think we are. And if we have $150 oil or worse, will that destabilize markets and the economy? Maybe. So far, people have been, up until the last couple of days, relaxed about inflation because they think the underlying rate hasn't risen. Mm-hmm. And they think fundamentally the energy-driven increases are temporary. But we're at a stalemate in Iran. There are really no good options. And the Iranians are emboldened, it seems, by their own tenacity.
There might be good options, but it depends on whether you're like a raving neocon that nation builder. I mean, I read this piece in the Journal today. There is an outline for what we need to do, but it includes boots on the ground. It includes destroying infrastructure. It includes just really bringing these people in, this leadership into submission and reopening the strait. And there's a case that can be made. It would be another tough decision by President Trump to do that with the midterms. Can I ask you, you talked about the markets and the economy could both be affected. Would the markets go first, or would you actually have to see some demand destruction in the economy?
I think the markets would go first.
And we wouldn't see it yet, because this could be recessionary in certain parts of the world, or even someday, even maybe in the United States, if it was really protracted, could it not?
It could be, although I think the U.S. economy is pretty stable right now. I think we may see the second big inflation shock of this decade after COVID.
From this,
and the higher yields we're seeing the last couple of days, 10-year over 460, 30-year, 20-year high, Japanese yields this morning, that may move up from that, which I think would be negative for markets. But I think the markets would move before the economy would.
You like Warsh?
I do like Kevin Warsh. I think he's a serious guy. I know him a bit, not a huge amount, but what I know I respect. And I think of all the choices President Trump could have made, he made a good one.
Was it puzzling that Trump would pick someone who is perceived to be a hawk? He's got to come up with a name for Kevin already, probably, because he's not going to.
As you know better than me, there were a lot of fears that he would choose
a dove,
or
even a lackey.
A lackey.
Yeah.
And he didn't.
He didn't.
And I give him credit for that. I think he deserves credit for that.
Yeah, but
it's a good choice.
It's a good choice. Do you think that he is more hawkish than? Was that reputation earned by him from the past, or does it just depend on what the current state of affairs are?
I think it's the latter. You never know. Over the years, Kevin obviously was critical of the Fed and critical of the Fed's expanded balance sheet and critical of the way the Fed measured inflation. But now that he's in the job, he's faced with a lot of practical realities. And I think he's going to react to those realities rather than, ideology or whatever you might call his prior views. I actually think he's going to do a good job. I think he's going to maintain the Fed's independence. Keep in mind, he's only one of 12 votes at the beginning. By the way, one of the really tough calls is going to be, I take that back. I don't think he's going to find it tough. But the federal funds futures markets, as of this morning, are signaling the greater likelihood of a Fed rate hike than a cut. Now, I don't think Kevin Warsh is going to hike the funds rate right off the bat, taking the job under these circumstances. But it's going to be hard to implement rate cuts anytime soon in light of what we're talking about here in terms of oil prices, inflation, and all that risk. Mm-hmm.